Thanks for clicking. The collapse of Silicon Valley Bank was a wake-up call to Canada's banking sector. This according to Peter Routledge, head of the Office of the Superintendent of Financial Institutions, or OSFI, at a speech given on Thursday. The speech comes as Canada's banks are reporting a major increase in the number of amortizations longer than 30 years, with OSFI warning that Canada's housing market is the biggest risk to Canada's financial system. And while OSFI proposed a new set of mortgage rules for the banks back in January, limiting the amount of riskier mortgage that the banks can hold on their books, Routledge's comments seem to indicate that the regulator was focusing on the use of variable rate mortgages as the primary target for new regulation.
You don't trust me.
So what I want to do today is go over Routledge's comments on Canada's mortgage market, including the regulator's worries over variable rate mortgages with fixed payments, take a look at a real-world example, and then discuss what to look for next. It's the start of a new month, so April's real estate data should start trickling out from the local boards any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. Onto the speech. Routledge's speech began by touting the success of the mortgage stress test, which OSFI, and I think most, would agree has helped to mitigate the potential negative fallout from the 425 basis point rate hikes that we've seen over the past year. In a speech, Routledge noted that Canada has just been through a 1980s level increase in interest rates, but mortgage delinquencies remain at historic lows. He also noted that we would have expected to see more defaults, more delinquencies with the rise in the cost of borrowing, but we haven't really seen any deterioration as of yet.
Wonder why?
And yeah, that's part of it. As we talked about so many times on this channel, holders of variable rate mortgages with fixed payments haven't really seen their payments increase. In fact, some banks, such as TD, have increased their amortizations by up to 40 years to ensure that their payments don't go up. So many borrowers, those with variable rate mortgages but fixed payments, have been extending their amortizations, extending the life of their loans so that their payments remain the same, but no money is being put down on principal. These borrowers are only making interest payments, and sometimes not even that. And with variable rate mortgages proving so popular during the pandemic, constituting over half of the mortgages taken out in July of 2021, Routledge says that this represents a potential risk to Canadian households and the Canadian economy as a whole, especially if interest rates remain elevated. And the reason, says Routledge, is the potential payment shock that happens at renewal. While the banks may be allowing homeowners to extend their amortizations past 30 years, go up to 40 years, when those loans come up for renewal, those loans snap back to their original amortization. As a brief example, let's take a look at Canada's average house price of $662,000 in July of 2021, back when half of all new mortgages that were taken out were using variable rates.
You can't afford not to.
We'll use minimum down payment requirements and a 25-year amortization with a decent insured mortgage rate of prime -1 or 1.45%. We get a monthly mortgage payment of $2,565, with $1,787 going towards principal and $777 going towards interest. But as interest rates started to go up the following year and prime hit 5.7% and that mortgage rate hit 4.7%, the minimum amount of interest due on that loan hit $2,504, very close to that original payment, and that's just interest. And that happened right around October of 2022 when the Bank of Canada raised rates by 50 basis points and prime went up to 5.95. So that homeowner had about 15 months of mortgage payments where they were paying down at least some of the principal. After that 15 months in October of 2022, their trigger rate would have been met, and their mortgage payment, their fixed mortgage payment, was no longer enough to cover the principal. Now, let's say that borrower was paying 1.45% for that whole 15 months. They weren't, but just to make it easy, let's say they were.
You're a lazy.
After those 15 months of paying that 1.45, that borrower would have owed $618,586, after which any payments that were being made were no longer paying down the principal. Now, let's say this situation continues and rates don't go back below that 5.7% by July of 2026. That's when the renewal comes. In July of 2026, they still owe that $621,000, but they have to snap back to a 20-year amortization, making their monthly mortgage payment $3,965, or about $1,400 more than the payment that was being made over the past 5 years. So that's an additional $1,400 in mortgage payments being made by this borrower at the time of renewal when the amortization snaps back to original, when it goes from a 25-year amortization back down to 20. Though the government is discussing some changes to this. And remember, nearly half of all mortgages that were being taken out in the summer of 2021 were variable rate mortgages. So that's a lot of potential payment shock coming down the pike in just a few years from now. 2020 renewals are only 2 years away.
I don't want to do this anymore.
And it's for this reason, Routledge says, that OSFI is considering additional measures that could attenuate that sudden buildup of variable rate mortgages, which come with a fairly substantial degree of risk for households. So while OSFI had mentioned back in January that they were considering limiting the amount of high loan-to-income and high debt-to-income loans that can be held on banks' books, after its consultations with the public over the past few months, and judging from Routledge's comments, it looks like they're going to be much more focusing on stress testing variable rate mortgages, making it more difficult to qualify for a mortgage if you take a variable rate. Now, that doesn't necessarily fix what happened in the past. Those variable rate mortgages with fixed payments are still on the books of the banks, and as mentioned, the government is discussing changes that would make it easier for borrowers to permanently extend their amortizations. What these regulations will do is A, make it less tempting for homebuyers and their advisors to pile into variable rate mortgages at a time when rates are abnormally low and have no place to go but up.
When will that be?
And B, it will push those home buyers who are already at their borrowing limits, who can't take additional payment increases in the future, it will push them into fixed rates, something which the study by Moshe Milevsky, the study that is so often cited by proponents of variable rate mortgages, actually advises. So, we have OSFI identifying Canada's housing market as the biggest risk to the financial system going forward, and it's identified variable rate mortgages as the target of new regulations, stress testing home buyers who want to go with variable rate mortgages more stringently going forward. With that said, all of this is still just talk. The consultation period is over with OSFI. Routledge is discussing this at his speeches, but we don't have the new regulations as of yet. When the regulations do eventually come down the pike, we'll obviously have an update out on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.